Welcome back to the deep dive. Today, we are taking a scalpel to the commercial real estate market.
And a very specific one at that.
That's right, the high-octane Dallas-Fort Worth region. We've got a really recent, highly curated document to guide us.
It's a market overview and listing summary from Eureka Business Group, or EBG, dated just November 15th, 2025.
It feels like a shortcut. You know, a look directly into the mind of a sophisticated DFW investor, showing us where the smart money is moving right now.
Exactly. Our mission today is pretty laser-focused. We want to unpack what EBG means when they say top opportunities or best value. We're not just reading a list of properties. We're figuring out what metrics really matter to successful investors, especially when things seem to be tightening up. You want to read on current strategies. This is the map.
Okay, so let's start with that market context. EBG mentions something very seasonal right at the top.
Yeah, they note a decline in new properties coming onto the market.
Which makes sense. As the industry slides toward the holiday season, a lot of people just pull back and wait for January.
But that's precisely what makes this so interesting. They're capitalizing on that inertia. EBG isn't just, sending out listings.
They're doing more.
They're inviting clients for a strategy call.
Yeah.
And the focus is on two very specific things: possible year-end tax-saving moves and planning for 2026 portfolio optimization.
So it's not about chasing new deals, it's about strategy.
That's it. The focus is on maximizing what you already have and executing deals that are time-sensitive. For a serious investor, November and December are for cleanup and setup, not for sprinting.
So if the market is slowing down, the properties that do make it onto EBG's list must be, exceptionally strong.
Or very strategically positioned, yes.
Okay, let's jump into that first section. What makes a commercial listing get handpicked by these guys? They're telling us they reviewed all the new commercial listings to find the best value for their clients.
And that curation is everything. You have to remember, EBG's background, they've been around since 2008, and they specialize in guiding retail investors, franchisees, business owners through retail CRE in DFW.
So they know their audience.
They know them inside and out.
Yeah.
When they handpick a list, they're speaking directly to investors who need, predictable cash flow and minimal headaches.
All right, let's start where they do. The under $2 million category. This is often the entry point, right? Or for steady portfolio growth.
It is. And the first listing is a 2,900 square foot medical/office property.
So why this one? What makes it stand out?
Well, it's about immediate value add and flexibility and some financial maneuvering. They highlight that it's actually two combined units.
Ah, so you can lease them separately.
You can lease part of it or all of it,
Yeah.
which is a great structural defense against vacancy risk. But the kicker is really two things, and they both suggest a motivated seller.
Yeah.
First, it's selling below assessed value. That's an immediate equity advantage right there. And second, critically, it has owner financing available.
Oh, that owner financing part is huge, especially if, like you said, the focus is on year-end tax planning. That changes the whole immediate cash outlay, the whole structure of the deal. You're less reliant on traditional banks, which can be tight.
It is. It creates speed and flexibility. Now, compare that kind of value add play to the very next listing, a triple net vet hospital.
A completely different strategy.
Completely. This isn't about flexibility. It's about, bulletproof income security.
So why is a vet hospital considered so secure as an asset class?
It's an essential service. It's highly recession resistant. And this one has a corporate guaranteed lease.
That's the gold standard.
It really is. You're de-risking the whole investment. The income is secured by a major company. Plus, it's a long-established 24/7 emergency clinic in a prime mall corridor with great demographics. You're buying guaranteed income in a place where demand is, it's locked in.
So a theme is definitely emerging here.
Yeah.
Minimizing what the landlord has to do seems key.
Oh, absolutely.
I mean, look at the single-tenant retail listings around that $2 million mark. They all seem to share one critical phrase.
I know the one you mean. Zero landlord responsibilities.
That's it.
That is the defining feature for the passive investor EBG is targeting. It's the pure N&N structure. The tenant covers taxes, insurance, maintenance, everything.
And you combine that with a brand new 20-year lease.
Right, and then you add in the built-in growth, the annual rent increases or bumps. It becomes a simplified, long-term hold designed for maximum efficiency. I think one even notes a strong 10-unit operator as the tenant. That's another layer of stability.
And they quantify the location, too. For one of them, they specify a high-traffic corner with over 27,000 vehicles per day on the TX35 loop.
And that traffic equals visibility. Visibility means sustained demand for the tenant, which at the end of the day secures the landlord's income. You're not just buying the building, you're buying the corner.
Okay, and the final one in this category, it seems like the ultimate quality play. The 7,000 square foot retail center, a trophy asset.
It is. EBG notes it's brand new 2025 construction, it's 100% leased, strong rent growth, and crucially, its location. Trophy Preston Road and Plano's Platinum Corridor.
Just the name Platinum Corridor sounds exclusive. What does that actually mean for an investor?
It signifies a very, very high-income, high-traffic area. The tenant mix is almost guaranteed to be premium and to stay that way. For an investor, it's about buying maximum quality, maximum stability, maximum future appeal. You pay a premium, but you're mitigating almost all the risk. It's the buy the best and forget the rest strategy.
All right, let's scale up. Section 2, moving into that $2 to $10 million range. The strategies here seem to shift pretty dramatically.
They do.
It's less about entry-level stability and more about leveraging, huge traffic, deep tenant investment, that sort of thing. It's not just about the entry price anymore.
That's the key difference. Once you have a baseline of passive income, you can move toward properties with more leverage, more complex structures. Take the 6,864 square foot single-tenant retail property. It's defined by an absolute NNN ground lease.
Okay, that's the holy grail, isn't it, of landlord-free income. Can you break down the difference for our listener between NNN and absolute NNN ground lease?
I can. It's a great question. So in a standard NNN lease, the tenant handles the three big costs. But in an absolute NNN ground lease, the tenant leases the land itself. They build their own building.
So they handle everything.
Literally everything, even structural repairs. There is virtually zero risk or responsibility for the landlord. You just collect rent on the land. And with 9+ years left on this lease, that income is rock solid.
But what really screams tenant commitment is that the source highlights it's newly renovated with a massive $1.5 million tenant investment.
That is the ultimate sign of tenant stickiness. A tenant does not spend that kind of capital if they're planning on leaving anytime soon.
No way.
And look at the traffic that supports that commitment. I-45 frontage with over 138,000 vehicles per day. That's a massive, massive driver of real estate value.
So that one's about security, but contrast that with the 10,500 square foot retail center built last year, also 100% leased NNN, but the appeal is listed as below market rents with upside.
Right.
Why is that attractive? It means less cash flow right now.
It signals a very strategic, proactive play. An investor buys stability now, with the new construction and strong tenants. But the real value is in the embedded growth as those leases expire.
You can raise the rates to market value.
And create instant equity and a huge jump in cash flow. It's a capital appreciation strategy that doesn't just rely on the property value going up.
Okay, so beyond standard retail, EBG also lists some development opportunities. We have a huge 37-acre land parcel.
Yeah, and the key details there are that it's zoned residential, it's a school district asset sale, CHISD, and it's a sealed bid opportunity.
So not a passive investment at all.
Not even close. Sealed bid means it's a competitive, non-standard process. It appeals to developers who need inventory now. And similarly, there's a 2.2-acre mixed-use lot. That one is purely a development strategy. Potential for 84 apartments plus retail.
And the source notes that the city is on board. It says the city supports corridor redevelopment efforts.
Which is huge. That's not about passive income. It's about getting in on municipal growth, getting favorable zoning. It's wealth generation through development.
Okay, now this is where it gets really interesting for me. In the highest bracket, 5 to 10 million, EBG moves away from traditional retail entirely.
Right, into the recession-resistant self-storage niche, a 362-unit facility.
A completely different operational beast.
It is. And its appeal is all about operational efficiency and future growth. The two big draws are, first, the rent increase upside. The unit mix is strong, so current revenue isn't even maxed out yet.
So there's immediate room to boost performance.
Immediately. And second, and this is crucial for a growing market like DFW, it has an additional acre for future expansion.
So you're buying a successful cash flowing business that also comes with development rights. It's like two assets in one.
Exactly. And the demand is already there. It's surrounded by the dense populations of Frisco and Little Elm. You're securing your customer base before you even raise the rents or start building. It's just intelligent long-term capital deployment.
So let's synthesize this. We've just analyzed a very tight, curated sample of the DFW market in late 2025. What did this teach us about how EBG defines best value right now?
Best value according to this, is a really complex calculation. It's way more than just the price tag. It means minimizing what the landlord has to do with things like NNN or absolute NNN leases.
It means maximizing security.
Right, through corporate guarantees or brand new long-term leases. It also means securing future income through annual rent bumps or buying properties with below-market rents that have that proven upside.
And leveraging location.
Always. Leveraging locations with high measurable traffic, whether it's 27,000 cars a day or 138,000 on I-45. Or just the pure prestige of a place like the Platinum Corridor,
Yeah.
stability and embedded growth. Those are the twin priorities.
So this gives us a really clear, actionable snapshot of where sophisticated money is going in what seems like a slowing market. They're buying stability, but also future potential.
And they're looking for structured solutions to navigate that market tightness.
Right.
And that leads to a final crucial question for you, the listener, to think about. ABG sees a seasonal decline in listings, but they're pushing hard for year-end tax planning. So given that 2 of their exclusive listings specifically mention owner financing available, how might that non-traditional financing be leveraged by an investor who needs to close a deal before year-end to minimize tax liabilities, especially when the market supply is so tight? Think about how owner financing changes the whole dynamic of closing before January 1st.
A fascinating and very timely thought to end on. That's it for this deep dive into DFW commercial real estate. We hope you feel thoroughly informed.